Are you ready to learn from the master of investments? Benjamin Graham's book The Intelligent Investor is not just an ordinary book about investments. It is the book that inspired Warren Buffett, one of the most successful investors of all time. Buffett has stated that he has read and reread this work more than any other investment book and considers it the best book on investments ever written. In today's video, I will share with you some of the key teachings that Benjamin Graham imparts in this incredible book, which will help you become a better prepared and successful investor, just like Warren Buffett. However, this is not just another boring video about finance. Instead, we will follow 5 different stories to learn 5 different key points from this timeless classic that will help you become a better and more successful investor. 1. The first key point is to understand the difference between aggressive and defensive investing. Imagine you are participating in a horse race and have 2 options: bet on the favorite horse, which has the highest probability of winning but with a lower payout, or bet on the underdog, which has a lower probability of winning but with a higher payout. Which option would you choose? Well, just like in a horse race, investing involves making choices between risk and reward, and the first key point of the intelligent investor is to understand the difference between aggressive and defensive investing. Aggressive investing involves taking more risks and volatility in pursuit of higher returns. This strategy is similar to betting on the underdog in a horse race. You may not win every time, but if you do, the payout can be substantial. On the other hand, defensive investing prioritizes capital preservation and risk minimization. This strategy is similar to betting on the favorite horse in the race. You may not win big, but you are less likely to lose your investment. Now, suppose you decide to bet on the underdog horse. At the start of the race, you may feel a growing excitement, but as the horses go around the first turn, your horse falls behind, the crowd gets louder, and your heart races as you hope for a turnaround. However, as the race progresses, your horse falls further behind, and you start to worry about losing your bet. You realize that you took on more risks than you could bear, and the potential reward may not be worth the stress. This scenario illustrates the importance of understanding your risk tolerance and investment goals before investing. Of course, both approaches have advantages and disadvantages, and Graham recommends finding the right balance between the two based on your financial goals and risk tolerance. As he famously said, the essence of investment management is the management of risks, not the management of returns. The second key point is to understand the concept of Mr. Market. Imagine you own a house and have a neighbor named Mr. Market. Every day, Mr. Market knocks on your door and offers to buy your house or sell his house to you. However, he changes his mind from time to time. Sometimes, he is excited and offers a high price for your house, and other times, he is anxious and offers a low price for his house. Initially, you may be tempted to accept Mr. Market's offers as true and react accordingly. However, you soon realize that Mr. Market's moods and opinions are not always based on rational or objective factors, but rather on his emotions and subjective perceptions. This scenario illustrates the concept of Mr. Market, which is a metaphor used in the book The Intelligent Investor to describe the daily fluctuations and volatility of the stock market. Just like Mr. Market, the stock market can be emotional and irrational, and it is up to the investor to remain rational and disciplined in the face of this volatility. As an investor, you should not let your mood and feelings influence your investment decisions. Instead, you should focus on the intrinsic value of the company and its long-term prospects. Just as the value of your house is determined by location, size, and condition, the value of a company is determined by its financial health, management, and growth potential. Therefore, when Mr. Market offers stocks of a company at a low price, it does not necessarily mean that the company is not valuable. It may be that Mr. Market is feeling anxious or pessimistic about the company's short-term prospects, but as a long-term investor, you should look beyond emotions and focus on the underlying value of the company. The main lesson here is that investors cannot let their emotions dictate their investment decisions. Just like the mood swings of Mr. Market, stock prices can be volatile and unpredictable, and it is important to keep a cool head and make rational decisions based on sound analysis. 3. The third key point is the importance of a margin of safety. Imagine you are building a bridge and want to ensure that it is strong enough to support the weight of people and vehicles crossing over. What would you do? Well, just like in building a bridge, investing also requires a margin of safety. The third key point of the intelligent investor is to understand the importance of having a margin of safety in your investments. Now, suppose you are building a bridge and know that it needs to withstand a weight of 10,000 pounds. Instead of building a bridge that can only handle 10,000 pounds, you decide to build a bridge that can handle 15,000 pounds. This gives you a margin of safety, ensuring that the bridge can handle unexpected events such as heavy traffic, accidents, or storms. Similarly, when investing, it is important to seek out companies with a solid financial position, stable earnings, and a good track record. By investing in companies with a margin of safety, you can protect yourself against potential losses and increase your chances of long-term success. Graham recommends always investing with a margin of safety in mind to protect against unforeseen events and potential losses. The fourth key point of the intelligent investor is to understand the importance of diversifying your investment portfolio. Diversification means investing in a variety of different assets such as stocks, bonds, and real estate to spread your risk and reduce the impact of a single investment performing below expectations. Investing in a variety of different assets can help protect your portfolio from the negative impact of a single underperforming investment. By diversifying your portfolio, you can potentially increase your returns and reduce the risk of losses. Let's suppose you have invested solely in one type of stock, such as technology stocks. If the technology industry experiences a downturn, your portfolio will suffer significant losses. However, if you had diversified your portfolio with stocks from different sectors like energy, healthcare, and finance, the negative impact of a technology sector downturn would be less severe. Moreover, diversification not only helps to reduce risk but can also lead to higher returns. By investing in a variety of assets, you expose yourself to more growth and return opportunities in different sectors and markets. According to Graham, a well-diversified portfolio should include a combination of stocks, bonds, and other investments, without any single investment representing a too large portion of the portfolio. Through diversification, investors can benefit from the potential growth of multiple sectors while minimizing the impact of a decline in a specific sector. 5. The fifth key point is the importance of fundamental analysis. Imagine you are considering buying a used car. The car looks great on the outside, but you're not sure if the asking price is worth it. You start asking questions about the car's history, such as how many miles it has, whether it has been in an accident, and if it has been well maintained. These questions are part of your fundamental analysis of the car. By examining the car's history and condition, you can determine if the asking price is fair. The fifth key point of the intelligent investor is the importance of fundamental analysis in investments. Fundamental analysis is the process of examining a company's financial health, its position in the industry, and its competitive advantages to determine its intrinsic value. By doing so, investors can identify undervalued or overvalued stocks and make intelligent investment decisions. Fundamental analysis involves analyzing a company's financial statements, such as income statements, balance sheets, and cash flow statements, to understand its financial health. Investors also examine the company's position in the industry and its competitive advantages to assess its long-term prospects. For example, suppose you are interested in investing in a company in the healthcare sector. You would start by examining the company's financial statements to understand its revenue growth, profitability, and debt levels. You would also research the healthcare industry to understand trends, competition, and the company's market share. By conducting a thorough fundamental analysis of a company, investors can identify whether the company is undervalued or overvalued. An undervalued company may present a buying opportunity because its stock price is below its intrinsic value, while an overvalued company may be a selling opportunity because its stock price is above its intrinsic value. Therefore, remember to conduct fundamental analysis before making any investment decisions and build a solid foundation for long-term success. These are some of the key teachings from Benjamin Graham's book, The Intelligent Investor. By understanding and applying these concepts, investors can make more informed and rational investment decisions and build a well-positioned portfolio for long-term success. Remember that investing is not a get-rich-quick strategy but a long-term journey that requires patience, discipline, and a commitment to continuous learning. By following the wisdom of Graham and other investment masters, you can become a smarter and more successful investor, achieving your financial goals. Thank you for watching, and if you've made it this far, don't forget to subscribe to the channel for more investment and personal finance tips.